Welcome back to Investing Talk Pod Guide.
Today, we are opening up the file on Figma, ticker FIG. And, right off the bat, if you still think this is just a design tool for, making pretty icons or tweaking colors, you're missing the entire story.
Okay.
This is effectively the operating system for product teams everywhere.
Mm-hmm.
And we're sitting at this massive pivot point with artificial intelligence. February 2026 is going to be remembered as a real shift.
Right. Everyone's asking the same.
Exactly. Is AI going to kill design software?
Yeah.
What we're seeing with Figma is something totally different. Despite all the noise, all that fear, they've pulled off a financial setup that is, frankly, it's a fortress, the kind of setup most SaaS companies can only dream of.
Okay, fortress is a strong word. As usual, before we start, subscribe, like, and comment to this video to support the show. It really does help us out with the algorithm. Now, Sarah, you use that word. You know me. I don't buy the hype until I see the hard numbers.
I know.
I look at balance sheets, not buzzwords. So let's get straight into the fundamentals, because looking at the data from yesterday, things are looking, well, I'll give you this much. They're looking interesting.
Interesting is putting it mildly.
Well, let's look at the cold, hard facts. They just reported their Q4 2025 earnings yesterday, February 18th. And credit where it's due. Not only did they beat estimates, but they also raised guidance for 2026.
Mm-hmm.
Usually when a company guides up in this macro environment, it's a sign that management sees something the market is missing. But the number that really caught my eye, and I need you to break this down for me because it seems almost too high, is the net dollar retention, the NDR. It's sitting at 131%.
Right. 131%. In the SaaS world, that is a massive, massive bullish signal.
Okay, so for the listeners who aren't, glued to SaaS metrics all day, let's pause here. Why is 131% so critical? Why isn't 100% enough?
So think of it this way. Net dollar retention measures how much your existing customers are spending compared to a year ago. If you have 100% NDR, it means your customers are staying, sure, but they aren't buying anything new.
They're just flat?
They're just renewing their subscription. It's a stagnant pool. It means you have to go out and hunt for every single new customer just to grow.
Which is expensive. Customer acquisition costs are always way higher than retention.
Exactly. But 131%. That means for every dollar a customer spent last year, they are now spending $1.31. It proves that customers aren't just sticking around. They are drastically increasing their spend.
Deepening the relationship.
Totally. To put that in perspective, even during the peak of the cloud boom, companies like Salesforce were celebrating 120%. Hitting 131 at this scale implies the product is viral inside the companies that buy it. It expands like a gas to fill the container.
Okay, so they're buying more, but what are they actually buying? Figma started as a UI design tool, basically a better version of Sketch. Are they just hiring 30% more designers? Because I look at the macro job market data, and it doesn't really support a huge boom in designer hiring. If anything, teams are running leaner.
That's the key insight, and it's where the bear case often gets it wrong. It's not just more seats for designers, it's what we call cross-product penetration. As of March 31st, 2025, the data shows that 76% of their customers were using at least 2 different products.
76%.
Yeah, that's a huge jump from previous periods where most people just use the core design tool.
So what are these other products? What else is on the menu that's driving all this spend?
This is where their strategy is just brilliant. They are capturing the entire value chain. So you have the core UI tool, everyone knows that. But then you have Figma Draw. This is their direct assault on Adobe Illustrator. It's for vector art, logos, illustration. Then you have Figma Buzz, which is their answer to Canva. It's for the marketing teams who need to make social graphics but want to stay in the same system.
So they're squeezing Adobe at the high end and Canva at the low end? That's ambitious.
Exactly. And critically, you have the new AI tool, Figma Make. This is their prompt-to-code engine. The strategy here is to own the entire design journey from professional vector work down to marketing slides and the actual code generation.
They want to own every pixel a company produces.
That's the goal, regardless of who produces it.
I see. So they're expanding the TAM by eating into everyone else's lunch. It's aggressive. But let's look at the safety of the company. We're still in a relatively high interest rate environment. Cash is king. I'm looking at the balance sheet. They have $1.6 billion in cash.
And look at the debt column.
I keep checking the footnotes to see if I missed something. It says zero debt. That's rare.
It is incredibly rare for a company expanding its product line this aggressively. Usually growth costs borrowed money.
Especially when you compare them to the incumbents. Adobe. Great company, a titan, obviously. But they carry legacy costs, they carry debt loads from acquisitions. Figma is sitting on a mountain of cash with no debt. That gives them a lot of flexibility, doesn't it?
Immense flexibility. It means they can invest aggressively in R&D, specifically in AI compute, which is expensive, without having to go to the capital markets or worry about interest. It allows them to play offense while everyone else is playing defense.
Right.
But I think the financial health is really just the fuel. The engine, the real thing that makes this company so valuable is the moat.
The moat. We always talk about moats. Is it just that designers like it? Because, let's be honest, designers can be fickle. They change tools all the time. I remember when everyone used Quark, then InDesign, then Sketch. Why is Figma different? Why isn't this just another flavor of the month?
That's true. Preferences change.
Yeah.
But Figma's moat isn't just preference. It's the multiplayer architecture. Before Figma, design was a solo activity. You saved a giant file, a PSD or whatever, emailed it to someone, they open it, it was siloed.
Oh, I remember those days. It's a nightmare. Version 2, final.zip.
Exactly. Who has the master file? Figma made design real-time multiplayer. Google Docs, but for high-fidelity visuals. And that created switching costs that go way beyond the designer.
How so?
Well, now, it's not just the designer in the file, it's the product manager leaving comments. It's the developer inspecting the CSS code in the sidebar. It's the marketer grabbing assets.
Yeah.
If you want to switch away from Figma, you aren't just convincing the design team. You have to retrain developers, PMs, legal, the entire organization.
That does sound sticky. It's organizational lock-in, not just software lock-in. And the market share numbers seem to back that up. I'm seeing here 82% share in UI design, 71.4% in basic prototyping, and this one is staggering, 95% of the Fortune 500.
95%. That basically means the war for the enterprise is already won. When you have that level of penetration, the biggest companies in the world, we're talking banks, automotive, big tech displacing you becomes a monumental task. You become the standard, like Excel for spreadsheets.
Okay, so the fundamentals are solid. Great cash, high retention, dominant market share. I can't argue with that data. But we're investors, not just business analysts. We need to know if the stock is a buy right now. A great company can be a terrible investment if the timing is wrong. So let's pivot to the charts and the technicals because the timing here feels significant.
It really does. The setup on the chart is mirroring that fundamental story.
We saw a prediction come out from JP Morgan back on February 10th. They called for a rebound. And looking at the broader context, it seems like the market is finally rotating back into high-quality software stocks.
After all that AI hardware volatility.
Exactly. The NVIDIA trade is cooling off, and money is looking for the next leg up.
That's exactly what we're seeing. There was this fear for, like, the last 6 months that AI would just replace software, so capital fled the sector.
Yeah.
Now people are realizing that AI enhances the best software platforms.
Right.
So you have the sector-wide tailwind, and then specifically for Figma, look at the price action after the earnings report yesterday.
Yeah. That after-hours rally was significant. It wasn't a slow climb. It was a gap up.
It tells us the market was underestimating their execution. The stock just popped. That is institutional accumulation into strength. The big players, the pension funds, the hedge funds, were waiting to see if the AI story was real, and the earnings beat confirmed it. They're chasing the price now.
And speaking of institutional players, I want to point out something on the flow side. You know I track unusual options activity.
Always following the smart money.
Exactly. Well, back on February 10th, the same day as that JP Morgan note, we saw a spike, specifically in call options. Heavy volume betting on an upside move.
Interesting.
It is. You put that together, the bank upgrade, the spike in call buying, and then the earnings beat just 9 days later. That timeline suggests to me that smart money was positioning for this. They were accumulating before the public saw the numbers. It's a classic signal.
It definitely looks like a coordinated move by institutional investors who did their homework. They saw the convergence of the macro rotation and the company's specific catalysts.
So the technicals show momentum. The big money is flowing in. But what about the broader sentiment? I always worry when everyone loves a stock. It usually means the top is in. What's the vibe out there?
Let's talk market perception.
I ran the quantitative scoring on the news flow for the last 9 days, looking for keywords, sentiment on headlines. The score is basically perfect. 5 out of 5 relevant news items were either positive or neutral positive.
And any bearish headlines. Usually you get at least one sell rating or evaluation concern.
0. Not a single one in the major financial press. That is rare for a tech stock these days.
Yep.
Usually there's always someone screaming bubble.
That's impressive. And I think a huge driver of that is the news that dropped on February 17th, just before earnings, the integration with Claude Code.
Right, the Anthropic partnership. I saw the headline, but break it down for me. Why is that such a big deal? I mean, companies announce partnerships all the time. Is this just a PR stunt?
No, this is much more than PR. This is the catalyst that proves the thesis. See, the existential fear for Figma was that AI models like Claude or GPT-5 would just replace the need for a design tool.
The fear you just type, make me a website into a chatbot?
And boom, you get code. No design tool needed. Right? Bypassing the interface entirely. But by integrating Claude Code directly into Figma, they're saying, no, we are the interface where that happened.
I see.
The workflow becomes you prompt Claude inside Figma, it generates the layout and the code, and then you refine it using Figma's tools. It positions them as an AI native platform. They aren't being replaced by AI, they're becoming the control center for it.
That makes sense. It neutralizes the threat. Instead of Claude killing Figma, Claude lives inside Figma.
Exactly. And the analysts are eating it up. We saw management on the earnings call citing strong AI adoption as a primary driver for the revenue beat. It's not just a story anymore, it's showing up in the dollars.
And you mentioned earlier this idea of the internet design generation.
Yeah, that's the narrative that is really taking hold globally. We're moving into a world where everyone is a designer to some extent. You making a slide deck, a developer making a front end. Figma is positioning itself as the tool for that generation, not just in Silicon Valley, but everywhere. Yeah. It's becoming a literacy skill.
Okay, hold on. We are getting very optimistic here. We're talking about fortress balance sheets, perfect sentiment scores. It sounds too perfect. And you know my job is to be the skeptic.
I do.
When things look this good, I start looking for the trapdoors. So I want to play devil's advocate. Let's look at the risks, because if I'm putting capital into this, I need to know how I lose money.
Fair enough. Let's look at the bear case. Hit me.
Risk number one has to be AI commoditization. We talked about Figma Make, their prompt-to-code tool. But let's be honest, everyone is building this. You have startups like Lovable, V0 from Vercel, Replit, Base44. They are all racing to do the same thing.
They are. It's a crowded field.
So if these startups achieve feature parity, if a tool like V0 can generate a UI just as well as Figma Make, doesn't Figma lose its pricing power? Why pay for a heavy enterprise seat if I can just use a cheap AI generator?
It's a valid concern. If the value is only in generating the UI, yes, it would be a race to the bottom. But here's the rebuttal. Customers don't stay with Figma just to generate a button. They stay for the workflow and the collaboration.
The multiplayer aspect again.
Exactly. Even if V0 generates the code, where do you discuss it? Where does the legal team review the copy? Where does the brand team check the colors? That happens in Figma. The AI might generate the raw material, but Figma is the factory floor where it gets assembled and approved.
So the lock-in isn't the pixel pushing, it's the human collaboration around the pixels.
You can't replicate that with a simple generator. The process is the moat, not the output.
Okay, I can see that. But let's talk about risk number two, the elephant in the room, Adobe.
The Adobe problem.
We cannot ignore the capital disadvantage. Figma has $1.6 billion in cash, great. But Adobe, they have a war chest that is significantly larger. They can outspend Figma on R&D, on marketing 10 to 1.
True, Adobe is a giant.
And what if Adobe just decides to bundle AI into the Creative Cloud and give it away for free to enterprise customers? They have their relationships with the CIOs. They can just say, hey, you're already paying for Photoshop. Here's our Figma killer for free. How does Figma survive that? We saw Microsoft do exactly that to Slack with Teams.
It's the classic bundling threat. And you're right, Microsoft crushed Slack's growth by bundling Teams. It is a real risk. However, I would argue that Figma's cloud-native architecture is fundamentally superior to Adobe's legacy roots. Adobe is still, at its heart, trying to move desktop-era paradigms into the cloud.
But does the CIO care about architecture? Or do they care about the bill? If Adobe is free, the CIO might just force the switch.
The CIO cares about what the teams will actually use. And that 95% Fortune 500 stat suggests the war for the enterprise is already won. The designers, the developers, the PMs, they have already voted. If a CIO tries to force them back to an Adobe tool just to save a few bucks, there's going to be a revolt.
You really think so?
I do. The switching costs are cultural as much as they are technical. Figma has won the hearts and minds of the workforce in a way Slack never quite did before Teams arrived. Design is now mission critical. You can't afford to give your product teams inferior tools just to save on a license fee.
All right. We've looked at the fundamentals, the technicals, the sentiment, and the risks. It's time to land the plane. let's get to the verdict. What's the final investment thesis?
Based on everything we've analyzed, the dominant market position, that fortress balance sheet, and this critical inflection point with AI, we're assigning this stock a bullish score of 8.5 out of 10.
An 8.5 is a very strong score from us. We don't hand those out lightly.
It is. It reflects high confidence. It's one of the highest conviction scores we've had this quarter.
And for the traders out there, how are we structuring this? What's the time frame?
I view this as a 6-12-month swing trade that naturally transitions into a multi-year hold.
Walk me through the targets.
In the near term, we're looking for about a 15 to 20% upside. This is the post-earnings drift. The numbers were good, guidance was raised, and it takes time for big institutions to build their positions. So we ride that wave.
And over the medium term?
Over, say, 6 to 12 months, we're targeting 25 to 35% upside. The driver there will be product adoption hitting that 85% mark across the suite. As those cross-product penetration numbers climb higher, revenue just compounds.
So buy for the earnings drift, stay for the platform expansion.
Exactly.
All right, give me the elevator pitch, the 30-second version.
Figma is the de facto standard for design with incredibly high switching costs. They have 82% market share, they are profitable, and they are debt-free. They're not being replaced by AI. They're integrating it to expand their market. If you believe software is still the growth engine of the economy, Figma is one of the highest quality assets you can own.
And there you have it, an 8.5 out of 10 bullish score. The numbers back it up, the sentiment is there, and the moat looks wide enough to hold off even the biggest competitors. That's going to do it for this analysis of Figma.
Thanks for listening.
Remember to subscribe, like, and comment if you found this valuable. We'll catch you in the next one.